In the second quarter of 2020, the economy was a wreck.
The worst ever quarter of GDP. Global growth is projected to fall by 4.9% this year.
Devastating impact on the jobs market.
But despite all of this, the stock market was climbing. So how come the economy was doing so badly while the stock market kept reaching new highs? Well, the answer to this question is quite simple. But the reason why it may seem hard to answer is because there is one thing that many people keep getting wrong, which is the biggest lie being told in investing. However, before we talk about it, we need some context. First of all, the stock market is not the economy. Because companies that make up the stock market account for trillions of dollars and employ millions of people, it's easy to believe that the stock market and the economy are essentially the same. But the best way to think of the stock market and the economy is to think of someone walking their dog in the park. Try to picture it. They're both walking in the same direction, but generally the person is likely to walk in a straight direction with very few deviations, kind of like an economic trend. The dog, on the other hand, keeps running back and forth, left and right, barking, chasing a squirrel maybe, and so on. That's the stock market. So they're both ending up in the same place, but there is a lot more deviation in how the person walks and how the dog walks. In other words, the economy won't fluctuate to the same extent as the stock market is. For example, this is the S&P 500 versus the GDP growth since 1957. You'll notice that in any given year, you can have some divergence between the two. For example, in 2009, real GDP fell by 2.5%, while the S&P 500 went up 26% that year. So they are related and will go in the same direction in the long term. But in the short term, they won't necessarily look alike. Short term is the keyword here, so keep this in mind because it will be very important later on when we talk about the biggest misconception in investing. Now, all things being equal, even if you knew how the economy would be doing next year, you wouldn't be able to know how the stock market will react. Any economic outcome could lead to various stock market responses, good, bad, or no response at all. It's important to remember that the stock market is impacted by all kinds of factors. So you can't really point to one metric such as GDP data or unemployment that can accurately tell you how the stock market will be performing. But what about the reverse? Can the stock market tell us what the economy is about to do? The answer is that sometimes it can. Stocks are believed to be a leading indicator for the economy, but many times they get things wrong or stock market prices overreact to things. For example, in 1987, the S&P 500 crashed 23% in one day, but the economy didn't even notice. And there are many reasons for this. But quickly, just before we talk about it, hit that subscribe button if you haven't already. I'm on a mission to get this number below 50%. Thank you. First of all, the thing with the stock market is that it only provides us with information on the public companies listed on the stock exchanges. It doesn't tell us much about the thousands of small companies that make up the economy. The giant companies that make up the S&P 500 operate under very different circumstances than small businesses, such as a corner coffee shop. While these smaller businesses might not be included in a stock index, their output, the people they employ, and the taxes they pay all feed into the wider economy. For example, the total US stock market includes just under 4,000 companies, but there are over 30 million companies in the US. So this naturally provides a skewed view of the economy. At the same time, because the financial strength of big companies makes them more likely to survive an economic downturn, their share prices tend to underplay the impact of a widespread economic collapse. For example, in 2020, major tech companies in the S&P 500 went a different way compared to both the US economy and the rest of the stock market. It's very easy to get confused by looking at the S&P 500 doing well and concluding that the economy is also doing well, without realizing that the performance of the market is, in most cases, the result of a handful of companies. This being said, there are instances when the stock market has been an accurate predictor of what would happen with the economy. The best example would be the dot-com crash in the early 2000s, when the stock market declined more than 50% and the US economy ended up in a long recession. So there are times when the stock market is giving you signals that something is about to happen in the economy, and there are times when it's giving you signals that amount to nothing. And being able to tell the difference between the two is very, very difficult, especially ahead of time. However, perhaps the most important factor to keep in mind when it comes to the stock market and the economy is that they focus on different periods of time. The stock market is forward-looking, meaning that investors buy and sell stocks based on what they think will happen, not what's already happened in the past. In other words, the market will tend to rise if there is a strong belief or confidence among investors that there is a bright future ahead. The stock market rally in 2020 is a good example. In the depths of the pandemic, this confidence was coming from the moves of the US central bank, the Fed, which slashed interest rates to nearly zero, making it cheaper to borrow money. They also made emergency loans available to banks, local governments, and other players in the global economy. These moves kept investors optimistic about the future. The economy, meanwhile, tends to look backwards. Every data that is published on the economy, unemployment, GDP rate, spending, inflation, and so on, is past data. In other words, it's already out of date. So even though the economy might be a wreck due to high unemployment, for example, the stock market might be on the rise if investors see good things happening in the future. Although that's not always the case, as we saw during the dot-com era. And that's the point I'm trying to make. There are a number of factors that can cause a disparity between the stock market and the state of the economy at any given moment. But the idea is that the stock market is not the economy. This being said, the biggest lie in investing that you hear time after time goes something like this. Well, the economy is doing better, so the stock market should be doing better too. Or the economy is a wreck, so the stock market is going to crash too. So why is that? Remember when I said earlier to keep the word short-term in mind? Well, this simple misconception is easy to believe, but it's simply incorrect, at least in the short term. The reality is that when the economy is doing great, chances are that stocks will underperform over the next 12 months. And conversely, when the economy is doing badly, chances are that you'll do very well in stocks over the next year. This isn't just my opinion, it's a fact. This table shows that since 1947, simply buying and holding stocks would have earned you a 7.3 compound annual gain. That's not bad at all, but the point I'm trying to make, and this table emphasizes, is that when the economic times are great, meaning when the economy has grown at 6% a year or faster over the preceding 4 quarters, stocks have delivered a compound annual gain of 4.2% over the next 12 months. However, when the economy has contracted over the preceding 4 quarters, stocks have delivered an astounding 18.5% compound annual gain over the next 12 months. So what's the reason for this? You see, great conditions get priced into the stock market. By the time things are great, stocks are usually too expensive. And when things are terrible, stocks become very cheap. You do make money in normal times, of course, but the biggest gains come after the economy has been shrinking, and stocks perform their worst after the economy has had a great run. However, as I said, it's important to note that this refers mostly to the short term. Over the long run, a healthy, growing economy is obviously good news for the stock market. But the problem is that many people confuse the stock market with the economy and end up selling out of the stock market when the economy is unstable, particularly during the short term. In fact, famous investor Guy Spears says in this podcast that investors shouldn't worry about the economy, interest rates, and so on.
Macroeconomics is important from a macro perspective, but we're operating on the scale of our own personal savings or the savings of us and our investors, and we're operating on at a completely different scale where it kind of doesn't matter for us. All we're trying to do is we're trying to own a piece of the productive economy. And maybe another way of looking at it is if you're a mouse or if you're an ant walking around amongst elephants, you absolutely care where the elephants are, and you care where they step and all of those things. But at the end of the day, what you need to do is you need to work on building your nest. You need to work on gathering food. And it's just at such a different scale that it's not going to affect what you need to do on a daily basis. And you shouldn't allow, in that analogy, the movements of the elephants to affect what is your daily task, which is to say own a slightly larger proportion of the world's productive assets.
Therefore, for most of us buy and hold investors, we shouldn't care much about how stocks react to different economic conditions. As long as we invest in a globally diversified index fund, there isn't much else we can do. But the thing is that index funds hide all kinds of secrets. So watch this video next to find out what the index fund industry doesn't want you to know about.